Hello, welcome back to my channel. If you're new here, my name is Elizaveta Boals and I am a bookkeeper for construction business owners. And on this channel, we explore the strategies and tools that help us run successful businesses and live happier, more productive lives. So today, I'll be talking about how to build a financial foundation for your business to ensure that success. Last week, we talked about the reasons why businesses fail and key things that makes them thrive. My video discussed how success isn't easy, but what you need to do to make it a possibility. So check it out. Now that we've nailed the foundational aspects of putting up a construction business, let's get down to what most of you are looking forward to, the financial and money-making aspects of being a contractor. Before anything else, let's look at the basic formulas and terminologies that we'll be using. So the first one, the most important one, markup. So it is your total sales divided by the cost of job. The markup is the difference between what a company sells its products for and how much it costs them to make that item. It's usually expressed as a percentage over their cost, meaning they sell you something at twice of what they paid for to gain the profit. Your markup will always be different compared to others because you have different numbers. Each company has their own independent way of computing their markup. So if you feel like yours is different, you don't have to worry. That's actually the problem that I most often find, that people are hung up a lot on those industry standards, but you don't know that person that uses that markup. What is their overhead? What are they paying for insurance? What are their profit needs? Everybody's numbers will be different. So another important one is margin. Margin is the relationship of sales price and net profit. That's what makes up the net margin. While gross margin talks about gross profit and sales price. Remember that margin is not a dollar amount, but rather a percentage. We compute the gross margin by dividing the gross profit by sales price. Companies use the gross profit margin to figure out if jobs can still be done. The higher their gross profit margin, the better it is. So the margin is the total gross profit divided by total sales. Another important one to know is break-even point. So it is your total overhead costs, total sales minus job costs, divided by your total sales. Another meaning, of course, job cost. I'm sure everybody knows that it's a total cost of goods sold. These are all of your job-related expenses, like the supplies you've procured from the vendor and any materials that you've bought from a third-party supplier. Maybe rented supplies, those are considered job costs, like your equipment. However, if it's regularly rented, it becomes an overhead expense like electricity or lease for a rental space. So the overhead expense, these are the expenses that are not related to any jobs you're working on in particular. Like I mentioned, it could be electricity, it could be your payments for office space, it could be your fuel, your office employees. Another one is the profit. Gross profit is when you're paid all your job costs prior to paying for your overhead expenses, right? So, but net profit is that bottom line, is what's left in your account after all expenses have been paid off. In the simplest sense, net profit is what matters because it's exactly the amount you have left for you to save, invest, spend. The chart of accounts is another term. A chart of accounts is a long list of financial accounts set up by an accountant to keep track and store all of your transactions. This allows bookkeepers to record all the transactions in your company's general ledger. So the next step is figuring out your financial requirements. Now that we have specific formulas and terminologies mastered, the next step is to figure out those requirements. So the first thing that's very important to think on is estimating job costs. To estimate the job cost of a job, you have to think about all the work that went into it. With practice, there should be no more than plus or minus 1% error in your estimates at any given project. Estimating is always a tricky thing, but it's highly important to stay as close to your estimate as possible. Having a successful estimate makes both you and your customers happy. So the last thing we need is to have surprises along the way. Imagine not having enough budget to finish a job. That's a very bad place to be in. So this is exactly what happened to some of my clients in the past. With the goal of winning pitches to increase their cash flow, they rushed into estimating job costs, thinking that the quicker they deliver, the faster they could get their customers. Indeed, they were able to close these deals, but in the long run, they ran into trouble because, think of it, consider job change orders and how often they happen. Add in the fact that they were trying to get new clients, so they had no idea how these customers thought or worked. They weren't able to include these considerations in their estimates. So what happened was that they had to either rush their customers into paying in advance or get the money from their own pockets when expenses began to skyrocket. And it all boiled down to job cost estimates. Never underestimate the estimates. A construction cost estimate is a projection of how much money the new structure will cost to build. The estimate plays an important role in success of any project, but it's especially critical for those involved with commercial building, architecture projects who need to get financing from the bank or investors before they start digging foundations. That's where it gets even worse. So here are some factors to take into consideration as you create your job cost estimates. So first is, of course, weather contingencies and changes. Forecasting weather is tricky, but it's necessary. You can't build a gigantic tent over a 50-story building whenever there's a hurricane, right? So another one is the use of equipment. Whether you are renting or buying equipment, you need to consider this factor. You also have to remember that equipment and machines can depreciate or even, back down. Another thing to think of is indirect costs, the expenses that arise when the business owner starts up their company. This includes all the permits, inspection fees, administrative expenses, their legal bills, technology overhead, insurance, security, utilities, you name it. And another thing to consider is, of course, changing prices of the materials. We have been in trouble with this one for a while now. I'm hoping it's gonna get better soon. So where and how do you collect the information you need? Construction estimators have a lot of factors to consider when predicting project costs. They look at historical data from previous projects, as well as opinions of the experts in their field. The following are some sources for construction cost information. So the first one is the best way to estimate the cost of a project is by using historical data, of course. Cost estimation methods in construction rely on this type of information, such as, for example, how much it costs per square foot for past structures and average labor hours for trade specialties like plumbers and electricians. This input can come from internal sources within your company or external sources that industry references use when they, hire those employees. The cost research is a process that can be both, laborious and time consuming, and gaining the most accurate data usually requires having to go back in time, but it's worth it. It's worth your while because you get complete look into what went down with cost at any given point of history. One expert also can be the difference between success and failure, because those experts in the construction industry have a wealth of knowledge, making them an extremely valuable resource when it comes to building something new and fixing what's broken with your home. For example, a master of HVAC contractors are expert at not only installing heating systems, but also at estimating costs within a range based on their experience. So you know the factors to consider. Now you also know how to collect the information you need. You're finally ready to perform construction cost estimates for your jobs. Again, no estimate is ever the same. So here are the 3 techniques that you can follow. I got those techniques from the multiple interviews I have done with very experienced estimators. So the first one is the unit rate analysis. It's a cost saving strategy for estimating project resources. It multiplies the average amount of materials required to install one unit from each MTO by total quantity in order to get an estimate with accurate with extreme accuracy. Using this method, you can adjust productivity per work activity and assign them into different sections of your business's schedule and tree to, actively trace that progress on productivity management. Another one is resource-based estimating. It's the process of using calendars and schedules to plan for resources. And this technique can be used if there's a schedule available, as well as material take-off access, because it uses those unbroken units instead of averages that are calculated from past projects. Another one is the factor estimating. It's a useful way to estimate the cost of materials and construction costs when no MTO or schedules are available yet. And this typically happens in early phases of the projects, but there's also an upside with this method. It provides fewer options for adjusting estimates based on the productivity. So now I would like to talk about figuring out and looking at how much profit you'd like to achieve. That profit first mindset, remember? While preparing a bid, estimators need to take the amount that they will have to add in order to cover their overhead and make a profit, right? Those 2 things. To ensure that the businesses are profitable and their operating costs are covered, estimators must know how much of an added markup and margin is necessary for making those calculations. And the only way this can be done accurately is if you first calculate what your business's estimated revenue should be, as well as knowing its cost of operation. This allows them to put together the appropriate markups and margins so that bidding on the jobs becomes more accurate. Goal setting is one of the easiest ways to increase your profit margins. It's hard for an estimator or the accountant to know what a business goal might be if it hasn't been set by the owner, right? And 10% isn't going to cut straight away. If you want higher construction profit margins, then you need to work together by coming up with achievable goals while still staying on the budget so there aren't any surprises down the road. Always remember to set SMART goals. What are the SMART goals? Specific, measurable, attainable, realistic, and time-bound. I want to make money. This is just not specific enough. You need to assign a percentage or a number to what you want to achieve as a construction company. The more specific you get on this, the better it is. Another thing that I wanted to talk about is that all businesses have overhead expenses. Even as a remote bookkeeping business owner, I have overhead expenses such as, my team, my own Wi-Fi, my electricity. Overhead expenses are necessary to keep your business running. Without Wi-Fi on my end, I won't be able to run my remote bookkeeping business now, would I? Overhead expenses can be both variable and fixed. Electricity, for example, is the variable cost because your electric bills can vary from time to time, depending on how often you use your AC, for example. Payroll and your Wi-Fi bill are examples of the fixed costs because they stay the same for the most part, unless your internet service provider decides to increase their rates, which rarely happens. So here's the business tip. Do not invest in a showroom straight away unless virtually showing your portfolio isn't enough anymore. These days, you can also save up on office space if you and your team are operating remotely because of the pandemic, right? Smart isn't just for goal setting. They'll also be useful for adjusting expenses to increase your profitability. That's this smart way to use things. Finally, how to predict and project sales volume. That's what I want to talk about. You can set the volume of your company in a way it's very specific for you and your family's needs. If you, for example, calculate the following, the total amount of money you need to pay the bills, 10% for charitable contributions, 10% savings account balance, additional taxes at 22 to 35%, total up all these numbers and divide by at least 8%. This will let you know how much business must be generated from this year onward to support both yourself and your finance goals, your lifestyle, your desired income level. Owning a business is a commitment that you shouldn't take for granted, for sure. I like to say that it takes 3 G's: guts, grit, and of course, growth. Building a financial foundation may be time consuming. It takes research and trust in other people to help you acquire the information you need, but in the end, it is so worth it. If you like this video, please subscribe to my channel to receive more videos like that. Leave likes, leave comments. That helps us reach more people who may find this information helpful. Thank you for watching.